For decades, US Treasuries have been the backbone of the global financial system. Central banks and investors around the world have bought trillions of dollars worth of US bonds, viewing them as a safe haven. Asia's giant economies, especially Japan and China, have been at the forefront. By investing their huge dollar reserves in US bonds, both Japan and China have not only financed the US but also stabilized their own currencies. Similarly, Japan and China have been significantly divesting its holdings of US bonds, causing considerable unease in the markets. Allegations suggest that the two Asian powers have sold around 45% of their US bonds, exposing the American economy to volatility. What does this move really mean? Is there an East Asian alliance behind it, or should it be explained more in economic terms? US Treasury bonds are one of the main instruments used by the US government to cover budget deficits and finance projects, especially since the 2008 financial crisis, during which US public debt increased dramatically. Central banks, on the other hand, have prioritized US bonds as a way to diversify their reserves, given the relative stability of the US economy and the dollar's status as the world's reserve currency. Japan and China have been the main actors in this policy, with Beijing at one time and Tokyo at another ranking as the largest holders of US bonds. Both countries played a critical role in financing US debt. Over time, however, a number of factors have changed this picture. First, geopolitical and trade tensions between China and the US have escalated. Washington's tariffs and restrictions on technology sparked a backlash in Beijing. The Chinese leadership realized that over-reliance on American bonds could put it at a disadvantage vis-a-vis the United States. It therefore gradually adopted a strategy of diversifying global reserves. This strategy involves diversifying into other currencies, such as the euro and the yen, and even assets such as gold. China is also seeking to strengthen its own monetary independence and, if necessary, to mitigate the threat of sanctions from the dollar system. As a result, Beijing is trying to diversify its reserve portfolio by selling some of its holdings of US bonds. On the Japanese front, the situation is different. While Japan is a close ally of the US, it is also a country struggling with domestic economic problems. In recent years, the Japanese economy has been grappling with low growth and high public debt. In the post-pandemic period, there have also been uncertainties in monetary policy. The Bank of Japan maintained a policy of monetary easing for a long time, but the global wave of inflation and exchange rate pressures made Japan's own bonds and reserve management a particular challenge. In this environment, Japanese leaders were inclined to look for moves that could support their domestic markets by reducing their holdings of US bonds or seeking alternative areas of investment. They also took steps to avoid excessive fluctuations in the exchange rate, such as selling dollars and buying yen at certain points, which required partial divestment of American bonds. So, how should one interpret the fact that these two countries sold as much as 45% of their bonds in the same period? The first question that comes to mind is whether there is a secret coordination between Japan and China. Considering their historical and political conflicts, it may seem counterintuitive for these two countries to cooperate closely. However, political conflicts are not always decisive in financial markets. Both countries may resort to similar steps to take a position in the US-China trade war and protect their economies. Tokyo and Beijing's simultaneous bond sales could also be a message to the US: if you exaggerate your measures against us, we will shake your leverage. Still, it would be an exaggeration to call it a clear alliance. Most experts believe that the two states may have taken similar decisions for independent reasons. But what would such a bond sale mean for the US? US Treasuries are traded on world markets every day, and demand for them remains broad-based. However, if big players like Japan and China were to sell large amounts, bond prices would fall and yields, interest rates, would rise. The US government would have to pay higher interest rates on new borrowing, which would increase the budget deficit and the cost of servicing debt. As a result, the Federal Reserve may have to revise its monetary policy settings, triggering risks of inflation or recession in the US economy. Moreover, even if the dollar's global position is not undermined, the possibility of dollar depreciation in the markets comes to the fore. Some scenarios suggest that this could have long-term consequences for the US. The US administration may resort to diplomatic backdoor negotiations to prevent this sale. For example, it has strong alliance ties with Japan, and the Tokyo administration could be pressured to slow down the sale of US bonds. With China, on the other hand, relations are already strained, and secret negotiations are unlikely. However, Beijing, as one of the largest holders of US bonds, may also be reluctant to continue selling rapidly because if bond prices fall too much due to its own sales, the value of the bonds it holds will also decline. Thus, selling all at once is, in a sense, self-destructive. This paradox could encourage the search for a win-win solution, but when political tensions come into play, everyone may take risks to protect their own interests. There is also the East Asian alliance dimension to consider. Could Japan and China really be acting in concert to shape the US economically? Historical tensions, maritime disputes, and ideological differences make it highly unlikely that the two countries would cooperate on such a large scale. However, some analysts argue that resistance to US influence is building in the region, and that Japan is also uncomfortable with US pressure. In particular, the US's own economic policies and security demands have sometimes been challenging for Japan. Still, Tokyo's official line is mostly close to Washington, so the term alliance may be an exaggeration. On the other hand, realpolitik interests can sometimes lead to surprising rapprochements, and there may be overlapping strategies in international financial markets. This keeps speculation on the agenda. But to what extent could such a move really shake the US economy? Some experts believe that markets are now so broad and deep globally that other investors could fill the gap left by the sale of Japan and China's US bonds. US bonds are still considered relatively safe, and significant funds could come in, especially from Europe and the Middle East. Nevertheless, in the short term, there could be a shock, and bond yields could jump. This would affect the value of the dollar, increase the risk of inflation in the US, and contribute to a recession. Washington cannot take such a scenario lightly. Therefore, news of a 45% sell-off creates a great ruckus in the political arena. Some American politicians are repeating the argument that dependence on foreign borrowing makes the US vulnerable. There are even calls for reforms that will reinforce the dollar's status as the global reserve currency. Others say that news of such a big sell-off may be exaggerated and should be confirmed by official data from the Chinese and Japanese side. The risk of selling US bonds cannot be underestimated because both Japan and China are big exporters. Destabilizing the US and the global economy would also put their own exporting companies in difficulty. Nevertheless, a certain amount of sales is considered wise, both for reserve diversification and to use economic leverage against the US. In the case of China, this argument is heard more often because, in a trade war with the US, Beijing likes to play the "if we sell your bonds, your interest rates will go up, and we will hit you economically" card. But this card is a double-edged sword. Japan, on the other hand, is generally considered to be the US's most stable ally, but its economic leadership may partially reduce its holdings of US bonds in line with its national interests. The theory of the reverse dollar mechanism is also feeding into this picture. According to this theory, the US prints dollars to finance its trade deficit, and the world redirects these dollars back to the US by buying US bonds. This cycle allows the US to borrow at low interest rates. Now, if major players like China and Japan withdraw from this cycle, the US's financing opportunities will shrink, and the dollar's role in the global system may decline. The question is the reign of the dollar being shaken? This question is revived with this development. However, throughout history, the dollar's place has been tested by many crises, yet it has endured. Nevertheless, experts warn that memory is short, and the dollar's appeal could wane if US politics is drowned in an environment of excessive debt growth and high interest rates. At this point, the US's domestic political problems also come into play. Rising budget deficits, public debt, political polarization, and the government's occasional difficulty in raising the debt ceiling are already partially undermining confidence in US bonds. The sale of Japan and China could accelerate these effects, although the official line is that it won't hurt the US too badly. Behind closed doors, economists and finance officials are rumored to be alarmed. Bilateral diplomatic initiatives, persuasive efforts to curb the sale, and even commercial negotiations may be on the agenda. The critical question that comes to mind when hearing about this sale is, will China and Japan continue to sell? Continued selling would permanently weaken US bonds, perhaps even causing some financial turmoil. A one-off or short-term move would create temporary volatility in the markets, which would then stabilize. In fact, neither Beijing nor Tokyo can reduce their huge reserves to zero because they would also suffer. Some analysts say, therefore, that although a sale of 45% may seem exaggerated, it may be more of an adjustment, an effort to adjust the reserve portfolio. Nevertheless, it is also possible that it is a warning to the US. In the long run, this development may push the US to view its economic policies more critically. Goals such as being more disciplined in debt management, not overborrowing by relying on other countries, and reducing trade deficits may be on the agenda. In addition, the US may have to raise interest rates to some extent to retain bond investors, which would have repercussions on the domestic economy. The Federal Reserve's monetary policy, inflation targets, and employment strategy may fluctuate accordingly. Those who ask whether this move by China and Japan shakes the US economic balance permanently have not yet received a clear answer. However, the issue of the size of the domestic debt and dependence on foreign investors seems to be more prominent in American politics. Returning to the East Asian dimension, most commentators do not see this joint sale as a direct alliance. This is because Japan and China have deep political and historical problems. The South China Sea, the East China Sea disputes, the Taiwan issue, tensions on the Korean Peninsula, etc., already bring the two countries into frequent confrontations. Japan is also a security ally of the United States. Therefore, Tokyo's intention to join hands with Beijing to deal an economic blow to Washington is not credible. The more plausible explanation is that the two countries independently decided to reduce the proportion of US bonds in their reserve portfolios. The coincidence of timing makes it look like a joint action, but in reality, both countries are pursuing their own national interests. However, sometimes great powers can take a "the enemy of my enemy is my friend" approach. While Japan is uncomfortable with trade pressures from the US, it is still dependent on Washington to counter threats from China. Therefore, it is unlikely that Japan will literally say, "Let's cooperate with China against the US." China, on the other hand, may use this situation for propaganda purposes in its media, saying, "Japan is also selling US bonds, so we can act together," but actual cooperation may be very limited. In short, while the East Asian alliance may sound glamorous, it has little basis in realpolitik. But the outcome is nonetheless significant enough to cause discomfort in the US economy. It shows that the US will no longer be able to maintain its comfort zone of "with the dollar's dominance in the world, we can spend as we wish and make others sell our bonds." Japan and China, together or separately, have the power to create volatility in the US market when they start selling their bonds. Moreover, even if new buyers are found, the higher yield could multiply the cost of US borrowing. While the markets are asking whether the risk premium on US bonds will increase, the US administration is worried that being so indebted increases its vulnerability. Thus, a more cautious approach to monetary policy and budget strategy may be required. In the Asia-Pacific context, this bond sale can also be read as an extension of the US-China trade war. Between trade disputes, technology restrictions, and maritime tensions, Beijing may be signaling the US by using its economic leverage. In the same way, Tokyo may turn to more yen-denominated assets in line with its own monetary policy, saying it is not optimal to hold so many US bonds. All in all, this action creates an uncomfortable result for the US. However, the claim of such a large amount of sales needs to be confirmed with precise figures, as official statistics can sometimes be delayed or implicit. Still, it is not good for anyone to risk that even this rumor loses its value in the market. This development also shakes the concept of US bonds as a safe haven. US bonds were a refuge that everyone ran to in times of economic or geopolitical crisis. If even the two biggest buyers, Japan and China, are selling, the question may be asked around the world, are US bonds really that attractive, or should we look for alternatives? The answer to this question depends on the dollar maintaining its reserve currency status in the long run, because most of global trade still revolves around the dollar, and financial systems are dollar-based. However, factors such as debt ceiling crises or government shutdowns in US domestic politics repeatedly raise the question, is the dollar reliable? This may lead large reserve holders like Japan and China to seek new options. After all, the statement that the US faces economic volatility as Japan and China sell 45% of their US Treasury bonds clearly shows how dependent the US is on external financing. In the event of a massive sell-off, bond markets could be shaken, interest rates could skyrocket, and financing the US budget deficit could become difficult. Some believe that the image of a direct East Asian alliance is exaggerated, as there is no motivation to actually bring Japan and China that close. Nevertheless, the fact that both Asian giants are taking similar steps at similar times creates a difficult picture for the US at both the economic and diplomatic levels. Washington could develop new strategies to cope with this development, such as strengthening ties with funds outside Asia, boosting domestic savings, or resolving the debt ceiling issue permanently. On the other hand, the market's view may be more dispassionate. If Asians are selling, others can buy because the world still needs US bonds, experts tend to say. Still, such a big wave of selling is bound to create volatility. At the end of the day, because the US financial system is deep, perhaps new equilibria can be established in the long run. But the risks of shaking the country's self-confidence and questioning the global attractiveness of the dollar are not to be underestimated. Of course, on the political side of this development, the debate continues. Are Japan and China making a move against the US, or are they both selling for independent reasons? If it is indeed a coordinated action, it could be a message to the US that we hold most of the national debt, and we are negotiating with you. However, Japan generally avoids using such tough diplomatic weapons, and China may want to use this tactic but is wary of the risk of damaging its own portfolio value. Therefore, the most likely explanation is that both countries turn to selling in a similar period of economic logic. The US market got a big shock, and Washington perceived it as joint Asian pressure. In response, the debate on what to do is heating up in US domestic politics. Some politicians say, let's focus on production, close our foreign trade deficit, and reduce borrowing. Others say, we can raise interest rates for a while, maybe this will increase the cost of debt, but it will maintain the attractiveness of the dollar. Another group argues, the world is becoming multipolar, we can't dictate everything on our own, we should seek compromise with Japan and China. In fact, this picture reflects the fact that the hegemonic position of the US is no longer as uncontested as it once was. In an order where economic power is at the center, Asia's giant reserve holders can put pressure on the US. Of course, there may be exaggerations in this story. Has the official figure of 45% really been reached, or is there a partial decline? Experts are waiting for the exact figures to be released. But even rumors are important for the markets because perception management can determine financial flows. Even if Japan and China make statements saying that the situation is exaggerated, the concern that bond sales may increase after this has settled in the minds of investors. This is a squeezing factor for the US economy. Likewise, even if the question of an East Asian alliance is exaggerated, the fact that Beijing and Tokyo show similar tendencies makes the US take scenarios such as what happens if countries in the Pacific Rim sell their bonds seriously. If Russia or some other countries were to follow suit, a mass dumping of US bonds could cause real turmoil. Of course, this would be potentially economically damaging for them because nobody wants to throw away the value of their assets. So, it's a kind of paradox of interdependence. The US is heavily indebted, but the world holds these debt securities and suffers from a sudden sell-off. Now, Japan and China are selling to a certain extent, but if an extreme scenario like we're selling all of it happens, everyone suffers. Therefore, tactical selling makes more sense. In conclusion, the news that the US, Japan, and China have sold 45% of US Treasury bonds not only points to the fragile points of the US economy but also calls into question global financial and geopolitical balances. How will Washington protect itself against economic volatility? Will Japan and China follow suit and further reduce their vast reserves, or will markets calm down again? The answer to all these questions is not yet clear. But what is certain is that large holders of reserves play a major role in the US debt market, and such a wave of selling is enough to set off a widespread alarm bell in the US. Claims of an East Asian alliance may be exaggerated, but if Japan and China sold bonds at the same time, the political repercussions would make the US rethink the danger of over-reliance on foreign debt. In the meantime, the world economy is beginning to ask the question: how independent is the global dominance of the dollar from the political maneuvers of the US? This question is being asked more frequently as the dynamics of global finance continue to evolve.